Man, look at the view out here. American Airlines sure know what they're doing.
Nah, man, that definitely got to be Southwest.
You guys are crazy. United Airlines has the best flights.
Wait, you sure that's not Delta?
Hello, my name is Byron Myers. I'm from San Diego, California, business marketing major, and my airline was American Airlines.
All right.
My name is Kari Bush, senior business administration major from San Bernardino, California. And for this group project, we had airlines, and my airline was Southwest Airlines.
Hi, my name is Frederick Q. Slaughter II. I'm a junior finance major from Atlanta, Georgia. The company I picked is United Continental Holdings.
Business finance major from Atlanta, Georgia, and my company is Delta.
Man, do you guys know about Southwest Airlines?
I don't. Tell us.
Wow, well, Southwest Airlines currently was founded, well, actually, before I begin on talking about all the great perks of Southwest Airlines, it was founded in 1971, so not that long ago, but, long before we were born, right? So right now, Southwest Airlines currently offers, they're known as a low-fare airline. So if you're looking not to spend that much money, you really want to take a quick trip, not expecting first class or things of that nature, because Southwest actually doesn't offer first class, you can expect low fares with Southwest Airlines and great customer service. So Southwest Airlines is actually known as an airline where you can go online, you can actually download an app as well, and really book a quick flight to anywhere you want within the U.S. They currently do not do international flights, but let's say, we're currently in Atlanta, Georgia right now, you want to get a flight to Florida, it'll cost you anywhere between, right now, $100 to $200. So people love Southwest for the consistency and low cost, as well as great customer service and satisfaction. There's no meals on their flights as well, so don't go on their flights expecting to be able to, eat and things of that nature, but really have that great customer service. And something that's cool as well is first 2 bags fly free. So with Southwest, you don't have to pay for flags. I know with, other airlines that we'll get into, such as Delta, United, and all these other airlines, you have to pay for, at least 2 luggages. So with Southwest, your first 2 bags fly free, and I've had a great experience with Southwest, and it's definitely a great airline. Thank you.
Whatever, man. Let me tell you guys about United Continental Holdings. So United Continental Holdings is an international organization. It links up with the Star Alliance to be a part of this cohort of over 400 different airports and airlines. So United Continental Holdings is a merger between United Express and United Airlines. So when those two merged, they became the largest airline in when you're measuring it for passenger revenue miles. And then also, so United Continental Holdings, what makes it special is it operates in hubs. So it has hubs in major cities like Newark, major cities like Denver, Colorado, Los Angeles, San Francisco, Guam. So different, key locations, and also uses. So by using the hub system, they're able to attack when they're attacking problems. They look at them more so from a hub perspective versus looking at it from a direct or an individual basis. Also, when you're looking at United Continental Holdings, you like that it's international and it's very cooperative with other organizations, and it's always able to get you to your destination because of the relationships it has developed over this time.
United Continental is an okay airline, but I would have to say that Delta is one of the best. I mean, just looking at the numbers alone, we are one of the largest airlines by traffic. We serve about 15,000 flights per day, which is sort of, if you put that into perspective, really big. When you're also looking at the markets as well, we are based out of Atlanta, Georgia, so that is our international hub. And so we have a national hub, so we travel all throughout the United States, and we also travel in Asia and in Europe as well. And so with those partnerships, we're partnering with different airlines within those different regions in the world, and we're serving a lot more customers, not just in the US, but elsewhere. For example, one of our largest airlines that we've decided to partner with is called China Eastern, and so that is a really strategic move on our part. Looking at our operations as well, We have the airline side, which is serving the consumer, and we also have the refinery side. So when it comes to our airlines and our flights, we in-house our own fuel, and so we're basically not going to a third party or anything like that, but we're using our own refinery techniques to fuel our own planes for the flight, which is pretty amazing. Like I said before, our headquarters are out of Atlanta, Georgia. We were founded here in Macon, Georgia, actually in 1924. We were originally a crop duster type of airline or airplane operation. We moved to Louisiana after that, and we started serving consumers on flights. And then back in 1941, we moved back to Atlanta to start, expanding our lines of travel. So I would say overall that, you got to go with Delta. Also, looking at our planes, we do have in-flight food for travel, international and national. Our legs room space is pretty amazing. You have to pay for the baggage space and everything like that, but you can't deny the quality and the service that we have, and also just our little amenities like first class, which we do serve, and then assigned seating as well, so you can pick if you want to sit in the window, the middle, or the aisle seat. So all around, I feel like Delta is one of the best airlines out there.
All right, Nolan, while I do, I respect that, Delta may be one of the greater ones, but no one beats American Airlines. American Airlines Group, we were founded in 1926 and have been operating for almost 100 years, 92 years going strong. And we are actually one of the biggest, if not the biggest airlines by fleet size, revenue, and just the amount of flights that we do daily, because American Airlines does at least, around 6,700 flights per day around the world in 50 plus countries. So that's a lot of locations that we operate in. As well, one of our major advantages to being American Airlines is not only our rewards program that we offer our customers, but as well, we also we have a merger with US Airways. Now this was a key merger that we have. It has provided us with a lot of extra leeway to go ahead and expand American Airlines to be the best serviceable airline versus our competitors. So again, no one can beat American Airlines, and that's just the way it is.
For United Continental Holding, the current ratio was below the industry average. A current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations. The ratio compares current assets to current liabilities. Thus, the equation is current ratio is equal to current assets over current liabilities. When doing the calculations for year 2017, I found that the current ratio for that year was 0.5611. This matched the Bloomberg's calculations because they calculated the current ratio the same way. So the industry average calculated by Bloomberg for that year was 0.7. So even though it's a little bit below the industry average, I can deduce that they are relatively able to pay off their short-term debts in 2017. For year 2016, the current ratio is calculated was 0.5949. Again, it matches the Bloomberg calculation, and the industry average calculated by Bloomberg is 0.78. So even though it again is a little bit below the average industry average of 0.78, we still can deduce that they are relatively able to pay their short-term debts. But in year 2015, the current ratio is 0.63, while the industry average is 0.83. So again, still under the industry average, but it still can be deduced that they have the ability to pay their short-term debts in 2015. So my prediction for the next year is that it will probably be the same 0.2 difference in the industry average and the current ratio, and I see them being consistent in that over the next couple of years. The next ratio that we're going to be looking at is an asset management ratio, which is total asset turnover. The total asset turnover ratio. So the total asset turnover ratio measures the full operating performance. It measures the value of a company's sales or revenues relative to the value of its assets. And to calculate total asset turnover, you just simply divide sales by the total assets. So when doing that, we see that for the year 2017, we see that the total asset turnover is 0.8916. It's almost equal to the Bloomberg calculated total asset turnover for 0.92. The difference may be in that we might have used different net sales versus regular sales or total assets, or they could be using an adjusted numbers when producing the sales and total assets. But the industry average calculated by Bloomberg for that year was 0.83. So we see that the total asset is about 0.1 greater than the industry average. So it can be deduced that that United Continental Holdings is efficiently using its assets to produce profit relative to other companies in the industry. In year 2016, the asset turnover was calculated to be 0.9104. So in that, the industry average calculated by Bloomberg is 0.85. So it's a little bit above the industry average, which is pretty good. And also for that year, showing that the company is efficiently using its assets based on the industry around it. In year 2015, we see that total asset turnover ratio is calculated to be 0.2967. This is while the industry average is only 0.9. So the United Continental Holding has shown consistency in being able to efficiently use its assets when comparing them to their industry and to the people around them. Next is the tie ratio. The tie ratio stands for times interest earned ratio. It stands for times interest earned ratio, and is a debt management ratio that measures a company's ability to meet its debt obligations. And it does that by comparing EBIT, or otherwise known as operating income, then dividing it by interest expense. EBIT can be found in the income statement, and the interest expense can also be found in the income statement. So for year 2017, we was able to calculate that times interest earned was 6.2576. The industry average calculated by Bloomberg for that year was 8.36. So it's about a 2-point difference from the industry average. It's 0.2 under. It's 2 points over, but we can still deduce that United Continental Holdings is relatively able to meet its debt obligations, and we shouldn't be too much worried about that. For year 2016, however, the times interest earned ratio was 8.0037, while the industry average is only around 7.22. So again, the industry average is actually 9.14. So we see still a 2-point difference in the industry average, but we can still say relative to the industry that they're able to meet their debt obligations. Again, times interest earned for 2015 was calculated to be 8.3323, which is significantly, not that significant, but it's a little bit higher than the industry average of 5.96. This could indicate that they may be especially able to meet their obligations, or that they're actually having a more difficult time meeting their obligations, or debt obligations. The last ratio is the profit margin ratio. The profit margin ratio compares net profits to net sales, and it does that by, it is a profitability ratio that is used to gauge profitability of a business. It represents how much sales has been turned into profits. So net profits and net sales can both be found in the income statement. And for year 2017, it was found to be about 5.65%. But for the industry average was 10.61%. So it can be deduced that they may not be as profitable as other firms in the industry because we see that 5% difference. Even though it might not be that significant to some, to others it might be more significant. Depends on the investor. The profit margin calculated for year 2016 is around 6.19%. So the industry average calculated by Bloomberg for that year is 8.13%. So this year we see we're a little bit under the industry average, and so that means we still may not be as profitable, but we're getting to the point where we are as profitable as the rest of the industry. In 2015, however, we see a big gap. The profit margin is calculated to be 19.39%, while the industry average is only 9.43%. So the profit margin for Continental Holdings was about 10% difference from the industry average. So in 2015, they're way more profitable in comparison to its future years, and that is more profitable than other firms in the industry at the time.
Hello, my name is Nolan Sadler, and my company is Delta. So, the first ratio that I will be discussing is the current ratio. The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations. The ratio compares current assets to current liabilities. Current assets include cash, accounts receivable, inventory, and all assets that are expected to be turned into cash in less than a year. Generally speaking, a current ratio that is in line with the industry average or slightly above or below is generally considered acceptable. If the current ratio is lower than the industry average, it indicates to the investor a higher risk of distress or defaulting on its liabilities. If the current ratio is higher than the industry average, it indicates to the investor that the management may not be using their assets efficiently. Nonetheless, the current ratio equation is current ratio equals current assets over current liabilities. When looking at Delta's current ratio, for 2017, Delta's current ratio was 0.42. In 2016, Delta's current ratio was 0.49, and in 2015, Delta's current ratio was 0.52. The total assets turnover ratio measures the value of a company's sales or revenues relative to the value of its assets. The total assets turnover ratio can be used as an indicator of the efficiency with which a company is using its assets to generate revenue. Generally speaking, the higher the asset turnover ratio, the better the company is performing, since higher ratios imply that the company is generating more revenue per dollar of assets. Now, looking at Delta's asset turnover ratio, we can see that in 2017, their total assets turnover ratio was 0.77. In 2016, it was the same, 0.77, and then in 2015, it was the same as well at 0.77. Now, going over to Bloomberg's industry average, we can see that in the year 2017, they calculated their Bloomberg industry average for the industry at 0.83. In 2016, the industry average is 0.85, and in 2015, the industry average is 0.9. So we can see that Delta's industry average is considerably a little bit lower than the industry average overall using the Bloomberg calculations. This means that Delta probably isn't generating more revenue per dollar of assets as the rest of the companies, but this is not a big concern. because in certain types of sectors, industry averages vary. So, for example, in the retail and consumer staples, they have small asset bases but have high sales volumes. Thus, they have the highest average asset turnover ratio. But conversely, firms in sectors such as utilities and real estate have large asset bases and low assets turnover. When it comes to the airline industry, I believe that Delta is slightly below some of the bigger and other airlines in America and that are private or publicly traded. But for an investor, this can be a very good opportunity to invest in a company with a lower total assets turnover ratio, because maybe in the recent years it will decide to grow with the expansions that Delta is starting to branch out, as such shown is in the Asian and European markets. The next ratio that I will be discussing is the time interest earned ratio. The time interest earned ratio measures the extent to which operating income can decline before the firm is unable to meet its annual interest costs. Failure to pay interest will bring legal action by the firm's creditors and probably result in bankruptcy. So now looking at Delta's time interest earned ratio, in 2017, their ratio was negative 14.79. In 2016, their ratio was negative 16.76. And in 2015, their ratio was negative 13.52. I deduced that since the formula for the ratio is EBIT, earnings before interest and taxes divided by interest charges, well, the numbers are negative because within the formula, the interest charges are negative for Delta. Now, it's kind of hard to compare these negative numbers to the industry average, because when you look at the industry average for the time interest earned ratio, Bloomberg calculates that in 2017 the industry average is 8.36. In 2016 it is 9.14, and in 2015 it is 5.96. Like I said before, Bloomberg's industry average was probably calculated with the interest expense being positive, leading to a different number and not receiving a negative number. But there are huge differences between the industry averages of Bloomberg's calculations and Delta's. Relatively speaking, without looking at the negative portion of the answer, the time interest earned ratio for Delta is considerably larger than the industry average of Bloomberg's calculations.
The current ratio is a liquidity ratio that measures a company's ability to pay short-term obligations. It is calculated as a company's total current assets divided by its total current liabilities. Southwest Airlines Company's current ratio for the quarter that ended in September 2018 was 0.71. It indicates that the company may have difficulty meeting its current obligations. Low values, however, do not indicate a critical problem. If Southwest Airlines Company has good long-term prospects, it may be able to borrow against those prospects to meet current obligations. Asset turnover measures how quickly a company turns over its asset through sales. It is calculated as revenue divided by total assets. Southwest Airlines Company's revenue for the 3 months ended in September 2018 was $5,575 million. Southwest Airlines Company's total assets for the quarter that ended in September 2018 was $26,674 million. Therefore, Southwest Airlines Company's asset turnover for the quarter that ended in September 2018 was 0.21. Asset turnover is linked to ROE percentage through dew point formula. The profit margin shows how the range in which you will gain revenue. There are many different types of profit margins. However, they all express the range of revenue in relationship with net income. Southwest Airlines Company net margin for the fiscal year that ended in December 2017 was 16.48.
As discussed, the current asset ratio is used to see if a company is able to meet its short-term debt obligations. Using the formula of current assets over current liabilities, we're able to go ahead and find out if American Airlines stacks up against its competition. Starting in 2017, we see that American Airlines' current assets are around $9.15 billion, and its current liabilities are around $14.96 billion. This makes its current asset ratio round out to be 0.6116. In 2016, its current assets were $10.32 billion at the time, and its current liabilities were $13.87 billion, which made the current ratio fall around to 0.744. And in 2015, the current assets for American Airlines at the time was $9.99 billion, and its current liabilities were $13.61 billion, having the ratio fall to 0.734. Unfortunately for American Airlines, this current asset ratio does fall short of the industry average of 0.85. However, just due to the fact that it may have a lower than average current asset ratio does not officially indicate that there is a problem that may be severely affecting American Airlines' ability to pay its debt obligations. Next, let's go ahead and look at American Airlines' total asset turnover ratio. As discussed, this ratio is used to find out how efficiently a company is able to use its assets to generate sales. Typically, a higher total asset turnover ratio indicates that a company is able to operate efficiently with its assets to generate income. Now, taking a look at American Airlines starting in 2017, its total asset turnover ratio was 0.8212. In 2016, its asset ratio was 0.7832. And in 2015, its total asset ratio was 0.8465. Over the course of their 3 fiscal years, this averaged out to around 0.8169, which is slightly lower than the industry average compared to its competitors. However, it's still able to keep on par compared to its competitors. Next in line is analyzing American Airlines' time interest earned ratio. The time interest earned ratio, or the TIE ratio, is a measure of a company's ability to meet and honor its debt. As discussed, this can be calculated by taking the EBIT, or the earnings before interest and taxes, and dividing it by the interest expense. Now looking at American Airlines' TIE ratio, in 2017, it had a TIE ratio of 3.9429. In 2016, it had a ratio of 5.38. And in 2015, it had a ratio of 7.056. Unfortunately, this is where American Airlines falls significantly short to its competitors due to their time earnings ratio averaging around to 5.4456 over the last 3 fiscal years. This is significantly lower than compared to other competitors within the industry where the average is around 14.34. However, an argument can be made that due to American Airlines' merger with US Airways in 2013, this is just the storm of the merger subsiding, and they will be experiencing explosive growth and consistent earnings in the future to come. Lastly, let's look at American Airlines' profit margin ratio. As discussed earlier, the profit margin is one of the more commonly used ratios for a company to analyze the company's ability to profit. And to receive the profit margin ratio, one must take the net income of a company and divide it by the net sales. Now, leading into American Airlines' profit ratio, in 2017, their profit ratio came around to 0.045. In 2016, their profit margin ratio came around to 0.0699. And in 2015, their profit margin ratio came around to 0.185. As seen over the past 3 fiscal years of American Airlines, their overall average profit margin came around to 0.09934, which is overall higher than the industry average of 0.07 and indicates that American Airlines is able to continue to
over the past 3 fiscal years, it can be seen that over the last 3 fiscal years, it can be seen that the overall profit margin for American Airlines rounded out to around 0.0934, which is overall higher than the industry average of 0.0736. And it indicates that American Airlines does have the ability to maintain profitability over an extended period of time.